Okay, party. Looks like I'm here. All this stupid messages, blah, blah, blah. All right, hopefully this is pretty intuitive. It seems like it. Okay, I'm going to get rocking. Thanks, dude. Bye. All right, y'all. First ever YouTube live stream. Super exciting. We got some friends in here. We got Partouche, Coop. This is good stuff. So what I'm going to go through, maybe a review for some of you. The typical YouTube watcher, it is definitely not review, at least from what I've seen. And that is the three financial statements and really understanding the three financial statements, the significance of them, what we're actually looking at when we're talking about the three financial statements. I think that's incredibly important because a lot of people just simply don't understand it. And that is what I'm going to dive into. I'm going to do my best to go back and forth with the comments because I'm going to have this up and then I'll end up having the chat as well. All right, party. So there we go. Okay. So what are the basics of building a model? Okay. I think ultimately, if we take kind of that lens and that perspective, then we're going to have a really good fundamental understanding of this whole process. So when you're building a financial model, which is literally what we do on Wall Street, we take the historical financials, we project them based on the relationships that we find, and we end up discounting those future cash flows back to today. So if you look, that is not a process where you're just doing a simple average, okay? You have to look at the historical relationships. You're going to use those relationships and craft projections from those relationships. You'll typically have several scenarios. So in the models that I build on YouTube, I have a bull case, a base case, and a bear case. The case that I always show is the base case. And you'll also have instances where you have a management case. So typically management will give us their ultimate predictions of what the company is going to do on a going forward basis. So who knows better than management? And typically what you'll find is management will under promise and over deliver. And the main reason for that is if they over promise and they don't hit those numbers, the market's just going to hammer them and the stock's going to tank. So once we have these relationships figured out, and I'm going to go through this and how we do this, but essentially if you take your own budget, if you looked at your expenses relative to your income, you'd be able to figure out what that net is. But what you wouldn't do is you wouldn't take that historical net and say, okay, that's 10%. I'm going to apply that forever going forward. What you would do is say, okay, what are my expenses now? And are those trends going to increase, decrease, stay the same? And then basically the net is going to fall out. That's a very important point. So ultimately we come up with these ratios. We got to be careful with things like COVID and other issues that are going to skew the numbers. So just be mindful of that. Then we're going to take those relationships. We're going to project the income statement and balance sheet. Once we have that, we're also going to look at the debt schedule. That's going to be a very important point. That's going to be a guaranteed cash outflow as the companies pay down their principal, they pay down their debt. And then we're ultimately going to get interest expense that comes out of that. We're also going to have calculations for retained earnings, PP&E. I'm just lumping in goodwill with intangibles, but ultimately you could just say intangibles, and then operating working capital. Very simply, that's current assets excluding cash, current liabilities excluding short-term debt. Once we have the income statement and balance sheet, we're going to utilize that to build the cash flow statement. We're going to determine if there's excess cash or a revolver. What does that all mean? Well, what you're going to see when we go through the cash flow statement, you're going to add together operating, investing, and financing cash flow. That's going to give you the net change in cash. If you take the beginning cash plus the net change in cash, you're going to get the ending cash. But the question is, do they have more, they being the company, do they have more cash than they need? Do they have less cash than they need? If they have more cash than they need, they're going to end up with excess cash. If they have less cash than they need, that's when they're going to need to draw on a revolver. So that, by the way, is how the balance sheet will always balance, because if you have a surplus, it goes to excess cash. If you have a deficit, it pulls on the revolver. Then, this is where the magic happens. We're going to use the cash flow statement to build a DCF, or discounted cash flow model. That will give us total enterprise value, probably having a little deja vu from the typical YouTube video. So We're going to generate total enterprise value. We strip out net debt. So we strip out debt, we add cash, we strip out non-controlling interest, we add associate investments. That's going to give us our intrinsic value or our equity value. We're also going to calculate a bunch of ratios that are going to fall out of this whole process. So if you're looking on a leverage basis or a credit basis, so I'm running a credit training program this week, we're going to look from a credit lens, debt to EBITDA, which is a leverage ratio, FCF over interest, which is a coverage ratio. And then you have, from the equity perspective, things like return on equity, return on assets, and return on invested capital. So that brings us to our first financial statement, which is the balance sheet. Very important thing to understand, a balance sheet is just a snapshot. It's just a point in time. And it's going to give us the sources and uses of cash. So the sources of cash are liabilities and equity. The uses of cash are assets. Now, this is very important because people get confused with this. They say, well, wait a sec, Ken, that doesn't make sense. I thought you have to pay down debt. So isn't that a use of cash? So when we say sources and uses, we're talking about at the outset. So if you look right below that, the balance sheet must always balance. Assets must always equal liabilities and equity. The liabilities and equity are sources of cash. The assets are uses of cash. So effectively, companies are going to the bank, they're getting debt, or they're going to the market and they're raising equity. And then they're using those cash proceeds to buy assets. That's ultimately what they're going to be doing. Now, the assets are going to generate future economic benefits. So for example, property, plant, and equipment is going to create products which we can ultimately sell. Liabilities and equity are going to have future obligations associated with them. So liabilities, thinking mainly debt, we're going to have interest expense. On the equity side, obviously, at some point, you're going to pay a dividend. Although high growth companies, they're not going to pay dividends straight out the gate. Current versus non-current, okay? Current means within the next 12 months. Non-current, greater than 12 months. All right, nice. We got some other subs here. What's up, guys? Now, very important to always think of how a transaction flows through the balance sheet, okay? This skill is critical for connecting the three financial statements, but it's also critical if you want to work on Wall Street. You need to know how these transactions flow through the financial statements, and that is going to be a critical component. So thank you for all you do. No, thank you. It's been a long time coming. Everybody tells me, they're like, bro, you need to do a live stream. I'm like, I will. And then finally I was like, I'm going to rip the Band-Aid off. I'm just going to do it. So please, by all means, anybody has questions along the way, just pop them into the chat. Happy to answer them along the way. So now you're like, whoa, wait a sec, Ken. This doesn't look like a balance sheet. This just looks like summary items. Where's the actual balance sheet? So what we're going to do is we're going to unlock or open up each of these pieces so that you could see the components. But high level, going back to the previous, okay, if we look at this previous area right here, we have assets equals liabilities plus equity. Now, if we go right here, those assets consist of current assets, non-current assets, okay? That'll give us total assets. Then we have current liabilities, non-current liabilities, equity. That's going to give us the total liabilities and equity. And assets has to equal liabilities plus equity, okay? Pretty straightforward stuff. So now what we need to do is we need to basically unlock these items. Dom, I see you. What's up, brother? So we pop this open here, and now this is where the magic happens. Now, I also want to explain this, everybody. When you look at this, okay, this is not necessarily what you're going to see when you look at an actual balance sheet. And we're going to do that a little bit later on. So I covered Google, Alphabet. I hate calling it Alphabet. I don't know why they changed the company name to Alphabet. It makes zero sense to me, but I'm not going to go on that diatribe. But net, it makes sense when you actually put this into context and you say, oh, okay, I'm actually seeing it in a real live company's financial statement. So we're going to do that a little bit later on. We'll hop into the Google Alphabet 10K and I'll walk you through, hey, this is like this, this is like this. But for those of you, and actually some of you here have either been trained by me or taken my financial modeling courses at Rutgers or elsewhere, you will recognize one of the things that I'm about to say, which is, if you have an item and you're like, I don't know what to do with this. I don't know if this is significant. I don't know what the deal is. Balance sheet items, we're just going to keep flat. Okay. What do I mean by keep flat? Just make it the same. Last year is the same as this year, all good. There's not going to be any associated cash flow. So if you ever were building a model and you were like, I don't know how to treat this item, just keep it flat. Okay. But the main items that are going to drive value are things like cash. Duh. All right. Cash received from the goods the company sells. Then we have an item like accounts receivable. So we are the creditor. We've made a sale on credit. We're going to receive future cash when it's paid. And then lastly, assuming that the company sells some sort of physical product, inventory. So we're talking about raw materials, finished goods, which we're ultimately going to sell for cash. The expensing of inventory is going to be captured via cost of goods sold on the income statement. So for those of you who have worked with me in the past, built financial models, you know very well that when we drive or project out something like inventory, we're going to look at cost of goods sold to come up with that projection. Those are our current assets. Now, will you see more than that? Yeah, you'll see a heck of a lot more than that. But these are the most important items. That's really the point that I'm trying to make for us here. Then we have, wait for it, drum roll, bam, non-current assets. Now, again, just so we're crystal clear here, this is not every single non-current asset that exists on planet Earth, but this is the most important one, okay? So property, plant, and equipment, fixed assets, things like buildings, machines, obviously equipment, that will generate future benefits by producing goods and services, which can be sold or allow us to generate future sales. Now, are there other non-current assets? Yes, there are. What are some examples? Something like Goodwill. Okay. If the company's made acquisitions in the past, they will have Goodwill. That's basically the premium that they've paid for an acquisition that they've made in the past. But essentially, those 4 items are all you need on the asset side. That's it. Now, when we actually look at a real live balance sheet, you're going to see a gazillion different items. And you're like, oh my gosh, what do we do with this? It's like the average analyst on Wall Street, when I train them, they're like, oh, what do we do with this? What do we do with that? It's like, oh, pump the brakes. Okay. You just need these 4. Everything else you could just keep flat. Good to go. Okay. If it doesn't drive value, we don't care. Goodwill doesn't drive value. It's literally an accounting mechanism. That's it. So that takes care of the asset side. Let's go move down to the liability side. So as I move down to the liability side, and here I'll do a little alt WFF action for my Excel shortcut friends out there. All right. So now let's come down to the liabilities. Let's just focus on these guys. Kazing, kazai, kazoom. There we go. So we have accounts payable. This is literally the inverse of an accounts receivable. With an accounts payable, we are the debtor. We made a purchase on credit and we will pay cash for it in the future. So what are the mechanics of that? We have a supplier, they sell us inventory. Okay. So if you think about it in terms of like assets, liabilities, and equity, you say to yourself, okay, I received assets. So my assets go up, but I didn't pay anything for it yet. So my liabilities go up. I have an accounts payable. Now, later on, when I pay that, what's going to happen? That accounts payable goes down, but the cash goes down. Balance sheet balances. Very simple stuff. Short-term debt, we're talking about debt to be paid within the next 12 months. The most common single type of short-term debt that we're going to come across would be a revolving credit facility. That's where companies can tap into if they need cash. We talked about if there's a cash deficit, that is what they would actually look towards. So net, these 2 items. You're like, well, Ken, I've seen a lot of others. Yep, I have too. Okay, but these are all we actually need in order to project out the financials. Now, moving on, we have non-current liabilities, long-term debt, debt to be paid after 12 months and beyond. Okay. Now, technically, you could combine short-term and long-term debt. You could absolutely do that. And then what you would do is you would just say, okay, that's total debt. And then you move on. Okay. Now, this area is also very important. If you adjust the formula, i.e., you say assets minus liabilities equals equity, now you're dealing with these items. So we have 4 items that we absolutely need here. So you'll see common stock, additional paid in capital. You'll see treasury stock if the company has a share repurchase program. And then lastly, retained earnings. Now, very important to understand the distinction between common stock and additional paid in capital. So in my models, I typically combine them and I just call it paid in capital. But if you look, which we will, if you look at the actual financials, you'll see a distinction. You'll see common stock and additional paid in capital. People are like, what's the difference? So very simple example. Let's say you did an IPO. So I'm going to IPO Kenco. All right. I'm going to sell 1 share for $10. I have a par value of $1. So it's like, okay, what's the difference? Well, I sold that one share for $10. So that means my cash goes up $10. So it's like, where's the rest of the money? Well, I said that I have $1 of common stock. So I'm missing 9. That 9 is captured in additional paid-in capital. Now, if you look at any company's financials, you go to the cover page, you're going to see what the par value is for each share of stock. They're going to disclose it. It's usually like literally less than a penny. And a lot of people wonder why they even have par value to begin with. So I can actually share with you a story. I do a lot of private valuation. So outside of the YouTube videos, I have a designation called a CVA, Certified Valuation Analyst. And private companies will use my services. I'll conduct valuations of their companies. Now, one time, company came to me. They were a coffee company, but it was like very different. These are like people who are like coffee nutcases. So like, and I'm a self-described coffee nutcase. Don't be mad. But I'm talking about like they were like creating stuff that was like edible that had coffee in it. So like basically take everything that's like going on with weed and they're trying to put it in everything. Like imagine that same process, but with coffee. Okay. So they had like coffee chocolates, coffee candy, coffee this. It was just like totally nuts. Well, no surprise. The company had like a massive negative valuation. And what they were doing was a restructuring. So they're basically taking the debt holders and saying, hey, we're going to give you guys equity. And then you could like leave us alone. And we're like, okay, that's cool. The problem is you can't do that unless you get rid of the existing equity holders. Now you can't just tell the equity holders, hey man, hit the brick, see you later. What you have to do is you have to give them fair market value. So now they retained me and they said, hey, let us know what you think. So I looked, I'm like, dude, this company is worth negative $48 million. Now, the way it works is we're talking about a corporation here. Okay. Either a corporation or LLC is the same structure. The most that you could possibly lose is your original investment. A partnership is different. Okay. I'm not going to go down this rabbit hole, but basically you have limited partners and general partners. Like in those instances, you could lose more than your original investment. Okay. So that's a totally different construct. In this case, it was a corporation. So the most you could lose as an equity investor is your original investment. So your investment's worth 0. Now, you can't just give these folks nothing and say, hit the road, take nothing and like it. What you actually have to do is say, hold on a second. I need to give you fair market value. I need to make you whole. So you can't just say, how's 0? What you have to do is say, hey, this is worth 0. It's actually worth negative 48 million. So I'm going to give you fair market value. I'll give you par value. All right. So you're giving them something of value, a penny per share. Okay. You take the number of shares, multiply it by a penny. Here you go. Good to go. All right. That way there's no lawsuits or any madness in the future. So then Treasury stock, those are the shares that are bought back. They're entered into Treasury. You're actually going to see the company will tell you exactly how many shares are in the Treasury. Okay. They can ultimately issue those shares later on if they so choose. They won't have to, hire investment bankers like yours truly. What they can do is they could just say, hey, we have shares in Treasury. We're going to issue those shares. Okay. So for example, let's say there was an executive and they had options that were in the money. They could literally just take the shares from the Treasury and make them whole that way. Now, last one, very important, retained earnings. Why is retained earnings so important? This is what's called a base calc. So we're going to have beginning retained earnings plus net income minus dividends equals ending retained earnings. So why is that significant? That's significant because that's how the 3 financial statements link together. Retained earnings is on the balance sheet. Net income is on the income statement. It's also at the top of the cash flow statement. And then dividends are going to be on the cash flow statement in financing cash flows. Okay. So that is the balance sheet snapshot point in time. But now what we need to do is we need to pivot over to the income statement. So let's do that. All right. So the income statement, unlike the balance sheet, which is just a snapshot, the income statement is more like a video. All right. You'll hear statement of earnings. You'll hear P&L, profit and loss statement. They're all synonymous. It's the income statement. So what it's ultimately showing us is sales or revenues and expenses over a period of time. Okay. So it's over a period of time. It's like a video. Now, it takes into account the money that the company makes from selling its goods or services. Now, you're going to subtract all expenses, both cash and non-cash, both operating and non-operating. So what does that mean? So cash expenses are going to be things like SG&A, interest expense, taxes. Non-cash items are going to consist of cost of goods sold, depreciation, amortization. Now, people get very confused with this. They're like, wait a second, how is COGS non-cash? It's like, okay, let's step back and understand this for a second. So inventory, all right? Inventory, when it is purchased, that is when the cash flow occurs, all right? Now, when you have inventory and you're now selling it. So I have a buddy who has a bagel store, for example. He goes to Restaurant Depot, he buys flour, eggs, all the stuff that you need to make a bagel, bacon, egg, and cheese, let's say. Now you go to his store and you say, I want a bacon, egg, and cheese. He doesn't now like send somebody out and say, like, go buy me one slice of cheese, go buy me an egg, go buy me two slices of bacon. Like that doesn't happen. He just goes in the back and grabs the stuff that he already bought. So there's no actual cash flow that's occurring. You're just reducing the carrying value of the inventory. So that's why it's non-cash. Okay. So now operating versus non-operating, that's another distinction. So when we talk about operating expenses, we're talking about COGS, cost of goods sold, SG&A, sales and marketing, general administrative, and depreciation and amortization. Non-operating, interest and taxes. So let's step back and understand that. So operating is going to change based on the sales that are generated. The more sales you generate, the more cost of goods sold you have. Ideally, you're going to hire more people, et cetera. And then also how you're generating those sales. If you have PP&E, you're utilizing more of that PP&E, which means you're going to have more DNA. We're seeing this a lot recently, obviously, with the Mag 7. Their CapEx is moving up, but also their DNA is moving up as well. Non-operating, interest and taxes. So that has nothing to do with the operations of the company. What it has to do with is what is the amount of debt that they have. Also, when you look at the taxes, where are they domiciled? So if you look at a company that's in like the great state of New Jersey, all right, that's a joke. I live in New Jersey, by the way. Or you're looking at Delaware, it's very different from a taxation perspective. Delaware, no income tax. New Jersey, lots of income tax. So it's like it's an apples and oranges comparison. You're looking at two companies there in two different states. It's not the same thing. Like it's not one has good operations, one has bad operations. It's one is domiciled in one state, one's domiciled in another state. All right. So let's do exactly what we did with the income statement like we did with the balance sheet. So the starting point of any income statement is going to consist of revenues. Okay. Now, what's interesting is we see gross profit, EBITDA, EBIT, EBT, net income. These are summary line items. Okay. Now, the other thing to understand with these summary line items is that they fall out. There was an individual, I think it was a Jeet, and he said that he was like 57 years old. He's getting into investing. I was like, rock and roll, dude. So we're going back and forth. And where he was making a mistake was he was looking at the historical summary item values, like the margins, and then he was extrapolating that going forward. It's not the right way to think about it because, for example, let's say I said, hey, Ken, what did you make last year? And I'm like, what do you mean? What did I make? It's like, okay, like, what did you end up with last year if you took in all the money you made and all the money you spent? It's like, oh, okay, what's kind of like my net income? Okay. Well, let's say it was a margin of 20%. Okay. Now, when I go to the next year, am I going to take what I make and then multiply it by 20% to figure out what the bottom line is going to be? That doesn't make any logical sense. There might be some expenses that I had last year that I don't have this year. There might be new expenses that I have this year that I didn't have last year. So it's an apples and oranges way of thinking. So what we're going to do is we're going to take the revenues, we're going to look at all the expense items, and then whatever falls out, falls out. Okay. So you're never, ever, ever going to do it when you're building a 3-statement financial model specifically. You're never, ever going to do it where you're just going to say, you know what, I'll just take each of these margins and then, I'll just totally disregard each of the individual expense items. Not the way to do it at all whatsoever. So let's look at each of these individual expense items so that we can understand those. So what is cost of goods sold? That is the expensing of inventory as goods are sold. All right. Very important that a company has positive gross profit. Okay. Incredibly important. Why is that the case? Well, if you think about it, if you're selling items for less than what it costs you, that's like a recipe for disaster. You're not long for this world. So ultimately, that is what you're going to have to make sure with 100% certainty that the company is generating positive gross profit. Okay. Please give the headline on what you're talking about right now. What question are you speaking to? So I am talking about gross profit. I'm literally just going through each of the financial statements. So like if you're like, hey dude, what's gross profit or what is cost of goods sold? Like that's where I'm at. I'm over on the income statement right now. So net, we have to have positive gross profit. Okay. This one's funny to me because, I had somebody on the channel and they're like, hey, could you look at a stock? I'm like, yeah, sure. What is it? And they're like, Archer Aviation. And I know people are going to go insane, lose their freaking minds, like YouTube troll fest. So I go look and I'm like, I can't find the revenues. So I go Control F, revenues. I like stopped there for a second. I'm like, holy bleep, the company makes no revenues. Zero. Never has. Now, it doesn't mean they never will, but you can't like figure out what the value of a company is. It'd almost be like someone's like, what's your net worth right now? And you're like, oh, it's billions. It's like, holy crap, man, you're worth billions of dollars. It's like, oh no, I don't have anything. It's like, okay, so how is that possible? I'm going to be. So I'm just figuring like I'll just say it right now. It's like, okay, that makes no logical sense. All right. You can't have no revenues and have like tremendous amounts of value. It's insane. It's total madness. But dude, if I did a video on Archer Aviation and I gave value of 0, run for the hills, people are like, you are a moron, you're dumb. It's like I can't even have a conversation with that person. Right. It's like a little kid being like, you're stupid. It's like, yep, I'm dumb. Bye-bye. You're not talking to like people that are using like ration or logic. Like you're trying to argue with me that a company has no revenue and it has tremendous value. Like that, I can't wrap my brain around that. Never will. So to that end, like assuming you do have revenue, you have to make sure at least the first level that you end up in a situation where you have positive gross profit. Okay. Now, ideally, it's positive all down the line. You got to have positive gross profit. All right. Period. Full stop. So now when we move to the next level, big important item, EBITDA. Okay. EBITDA, that is a non-GAAP number. It stands for earnings before interest, taxes, depreciation, amortization. Now, there's two components here. Oftentimes, this will be combined into one item called SG&A, but it's actually split into two items. One is sales and marketing. So that's cash spent directly and indirectly in the process of selling a product or a service. General administrative is overhead. So that's cash spent on anything not directly related to producing the good, mostly fixed in nature. So when we look at sales and marketing, think of like commissions. When you think of general administrative, think of things like overhead. Okay. Now, in the example I was giving, if a company has negative gross profit, they haven't even paid their employees yet. They haven't paid their rent yet. So how long can a company sustain if they have negative gross profit and still pay their employees and still keep the lights on? The answer is pretty simple. It's not long. Okay. So now moving on from EBITDA. And by the way, EBITDA is important because it is the way that you can look at companies on the most apples to apples basis. As you start going further down, it's going to be much harder to compare one company to another. So when you look at net income, for example, tech companies, they have a ton of net income. Why? They don't have much capital expenditure, so they don't have much DNA. On the flip side, when you look at a company like a telecommunications company or an industrials company, they'll have a ton of CapEx. So looking at them on a net income basis is a total apples and oranges comparison. Basically, the higher you go, the more comparable companies are ultimately going to be. So now when we go to the next layer, we have EBITDA. We have to strip out depreciation, non-cash expensing of fixed tangible assets, PP&E. Amortization is non-cash expensing of intangible assets, things like patents, trademarks, etc. So that brings us to operating income or EBIT. I'm going to do a little Alt WFF action right here and then move on from there. So then after that, we get to pre-tax income. So we have to strip out interest. So this is the cash expense for the debt. Now, very important. You'll hear people use the term interest is tax deductible. And it's like, it's not the right way to think about it. Like when you think about yourself as an individual and you're like filing your income taxes and you're like, okay, I'm going to itemize my deductions and I'm going to deduct the interest that I spent. It's not like that. all it really means is that the interest is paid before taxes are paid. So if interest is high enough, you might have no pre-tax income, which means you pay no taxes. That's really what that means. So just wanted to clear that up. And then finally, we pay taxes, cash taxes paid to state, local, federal governments. We end up with the bottom line net income. So again, how many items are there here? 1, 2. I would combine that, say 3. You could combine that, say 4, 5, 6. Okay. So 6 items. Now, there could be a lot more, but there's 6 items that you absolutely need to understand the functioning of a company and then ultimately utilize those to project and create a financial model. So when we go one step further, we want to think about the significance of these summary line items. Okay. So gross profit, as I was mentioning, incredibly important line item. All right. Incredibly important line item. Revenues minus cost of goods sold. This has to be positive. Absolutely critical that this is positive. So the expenses to produce a good should be less than what you sell it for. You cannot spend $5 producing something that you sell for $4. That literally means you're losing $1 on every single one. That company is not long for this world. So now, when we move from gross profit, what is that next layer? That would be EBITDA. So gross profit minus SG&A, sales and marketing, general administrative, that's going to bring us to EBITDA. Now, what is the significance of EBITDA? It's very important for leverage and coverage ratios, determining debt limits, and as I mentioned earlier, it is going to be the absolute best way to compare one company's operations to another. It excludes capital structure and capital budgeting. What does that mean? Capital structure, interest, capital budgeting, depreciation. Okay. When we get to the next level, we have operating income, which is EBITDA less D&A, and then also taking into account one-time items. What's a one-time item? So things that are non-recurring. So let's say, for example, a company gets into a lawsuit. Okay. That would be considered a one-time item. They have an impairment. That would be something that's considered a one-time item, etc. So this is going to take into account capital budgeting, which means the depreciation from PP&E and the amortization from any intangibles. It will take that into account. So then we come to pre-tax income, which is going to be that operating income minus net interest, which is interest expense minus interest income. Now, what is the significance of that? Glad you asked. It takes capital structure into account, so the interest expense related to debt, as well as any interest income generated from invested cash. So we've seen this with the Mag 7 companies that we look at. They generate an absolute ton of cash. So they will actually have, in many instances, more interest income than interest expense. And then last but not least, net income. So net income takes into account taxation. This is the bottom line after all expenses are taken into account. And when we have the income statement and the balance sheet all squared away, that is going to lead us to the cash flow statement. If you only had one choice of a financial statement to look at, the one that you would look at is the cash flow statement. Now, super high level, operating, investing, and financing cash flows. Operating cash flow, that's the internal supply of funds. So remember, short term, current assets, current liabilities. Investing cash flow is the demand for funds. So that's long-term assets, long-term liabilities, greater than 12 months. And then we have financing cash flows, the external supply of funds, things like debt and equity. Now, what about the individual components? I'm glad you asked. So we have net income. We add back the non-cash expenses, so namely depreciation and amortization. And then we take into account changes in operating working capital. So this is basically current assets excluding cash, current liabilities excluding short-term debt. For the investing cash flows, the main one is typically going to be CapEx. So capital expenditures, additions to PP&E. And then we have changes in non-current assets, changes in non-current liabilities. Last but not least, we have our financing cash flows. So this will consist of net proceeds from debt, both debt pay downs and debt proceeds, net proceeds from equity. So if they issue new equity or they repurchase shares, that would be captured there. And then last but not least, we have dividends. So now when we tie this all together, that is going to give us our net change in cash. We take beginning cash plus net change in cash. That will give our ending cash. Now, based on that ending cash number, we're going to compare that to our required cash. If we have more than we need, i.e., we have more ending cash than required cash, we have excess cash. That's going to generate interest income. If we have less cash than we need, That's going to generate a deficit. We're going to have to draw on the revolver. That is going to generate interest expense. So now, taking it full circle, how do the three financial statements link together? That is the calcs. All right. There's three main base calcs. Base stands for beginning plus additions minus subtractions equals ending. So we have, for example, beginning retained earnings plus net income, which is going to be on the income statement and the top of the cash flow statement, minus dividends. So that's going to be in the financing cash flows, ending retained earnings, balance sheet. We got beginning PP&E, balance sheet plus CapEx, investing cash flows minus depreciation. That's going to be on the income statement and the operating cash flows. That's going to give us ending PP&E. And then we have beginning intangibles plus any new purchases of intangibles. So that's the equivalent of CapEx for intangibles minus amortization. That will give us ending intangibles. The other calculation that will typically break out separately, operating working capital. That's current assets excluding cash, current liabilities excluding short-term debt. A lot of people get confused in terms of what these cash flows are and directionally how they work. So I like to use the example of a car and a loan. Very simple, okay? So an increase in an asset is a cash outflow. Think about it. If you buy a car, what happens? Your assets go up, you have a car, but your cash is going down, okay? What happens if you sell that car? Your asset goes down, your cash increases, cash inflow. So there's an inverse relationship between assets and cash. Remember, assets are sources or uses. Those are uses of cash. So increase in an asset is going to be a use of cash. Now, on the other side, liabilities, they have a direct relationship. So if you go to the bank and get a loan, your liabilities increase, but also your cash increases. You pay down the loan, your liabilities decrease, but also your cash decreases. So they move in the same direction. On the other hand, if you raise equity, okay, what happens? You sell equity in the market, cash is received, you buy back shares, cash is utilized. So there's a direct relationship between liabilities and equity and cash flow, meaning those are sources, okay? And then an indirect relationship between assets and cash flow. Those are uses. To take it all home, connecting the three financial statements and rules for the cash flow statement. And then we'll open it up for any questions with that. And I can even walk through the Google financial statements, Alphabet, so that you can kind of see a picture of where all this comes from. And then I'll even go really bananas and I'll show you what I do. I actually take those financials and I put them into a Microsoft Excel file and build a financial model from scratch every single time. So connecting the three financial statements and rules for the cash flow statement. All right, so let's walk through this, okay? We have the balance sheet, okay, over here. So what does that consist of? So we have cash, current assets, PP&E, long-term assets, okay? So this is just like 50,000-foot view. We have liabilities, current liabilities, and debt. Equity, we have common stock and retained earnings. Common stock, think of paid-in capital, okay? Now, how do all of these pieces connect? Well, we have our income statement here. So we have revenues minus operating expenses and then non-operating expenses, interest and taxes. Okay, that gives us net income. Remember, net income gets added to retained earnings. It's also the very start, the very top of our cash flow statement. So then when we look and see, okay, what is the change in cash? We take into account increases and decreases in cash, or sources of cash, inflows, uses of cash, outflows. We take into account all of those. That will give us our net change in cash. We then take that net change in cash and we add it to the cash balance, and the cycle continues. Now, if you get confused and you're like, I don't know like how I would actually go about deciding where something would go, these are the distinctions. So cash is going to be excluded from the cash flow statement because the net change in cash is ultimately going to be added to the cash. So we don't want to double count it. So to have cash in the cash flow statement would ultimately result in double counting. So this is the order that I would advise going through. Okay. So first, number one, is it debt or equity? If the answer is yes, it's going to be in the financing cash flows. Number two, is it a current asset excluding cash or a current liability excluding short-term debt? That would be in the cash from operations. Number three, we have the base calcs. So we have PP&E, which is going to consist of CapEx and depreciation. CapEx is investing cash flow. Depreciation is operating cash flow. Intangibles, if we have it, we have new intangibles, which is the equivalent of CapEx. That'd be in the investing cash flows. Amortization, that's in the operating cash flows. And then we have the retained earnings base calc, net income. That's going to be the very beginning part of our cash flow statement. Start the cash from operations, and dividends. That would be in the cash from financing. And then last but not least, if we have any long-term assets, long-term liabilities, that would be in the investing cash flows. So that is everything that you need to know about understanding the three financial statements and the different pieces and components in, I guess it was 40 minutes. So that's literally as simple or as complex as it is. It's not really that hard. Those are the main items that drive value. Everything else, for all intents and purposes, is just not important, not relevant. If it's an income statement item, you would ultimately make it zero. If it was a balance sheet item, you would keep it flat. So there's no like big, great secret to this or anything of the sort. Now, what I'm going to do is I'm going to share the Google or Alphabet 10K. It's always going to be Google to me. Let's go see. Dun, dun, dun. No, I don't want to share the live stream. Oh, okay. Sharing this. Oh God, it's me. All right. Let me go share. Wait for it. Window. There we go. 10K for Alphabet. Party. All right, y'all. So where are the financial statements? So don't be afraid here, friends. This is a 10K. All right. The 10K is the annual report for a company. And it's very important that you know and understand this. I would say, based on at least what I've seen on YouTube, most people don't even look at this stuff. They just like look at like lines on a graph and they're like, oh, value, go up, go down. Like, I don't understand. But if you actually want to like legitimately understand a company, you're going to have to pop in to the financial statements. So the 10K, all right, first you see what year it's referring to. So December 31st, 2024. Okay, we got Alphabet. I mentioned this in the video. So the Class A shares are under GOOGL. Class C are under GOOG. I did get a kick out of the comment that I got. Voting doesn't matter. Okay. So yeah, Google, GOOGL, has voting rights. GOOG does not. But ironically, GOOG actually trades at a premium. It's like the most bizarre thing in the world. Makes no sense. Now, if you look on this continuation of the cover page, they will disclose how many shares are in each class. So they have 5833 million of the Class A, 860 million of the Class B, 5497 of the Class C. So you have to add all of those together to get the total shares outstanding. So they have multiple classes of shares. So the B stock is owned by Larry Page and Sergey Brin. It's also owned by another few individuals that are like at the management level. Good question. Would R&D be new intangible? Very good question. So research and development would just be another expense item. So you would typically see cost of goods sold, SG&A, and R&D. And I'm almost positive that in the case of Alphabet, you're going to see R&D. If not, I know that Amazon, which I'm looking at right now, they do have R&D, research and development. But good question. Yeah, so it's not related directly to the intangibles. It's expensed. And then if it ends up creating an intangible, it would be capitalized accordingly. So let's go take a look at the financial statements right here. So we see item 8, financial statements and supplementary data. So the cool thing is we could just click that hyperlink. It's going to bring us down to Chinatown. And what we're going to see is each of the associated pages that correspond to each of the financial statements. All right. The ones that we care about: balance sheet, income statement, cash flow statement. So comprehensive income is just putting like a magnifying glass on the comprehensive income portion of the equity portion of the balance sheet. And then statement of stockholders' equity, again, is really putting a magnifying glass on the equity portion of the balance sheet. And then we talked about the cash flow statement, very, very important. So you could either click the pages or just hit page down like so. All right. So here we go, yo. So first, we're going to start with the balance sheet, just like we did in the Excel presentation. We have cash and cash equivalents. We also have marketable securities. Now, here's the beautiful part, friends. If you're like, I don't understand what this item is, I don't understand what a marketable security is. What you do is you do Control F, type in marketable securities, and it will bring you to an area that will have a note that will explain exactly what marketable securities are. So what are marketable securities? So these are going to consist of basically things that the cash is invested in. Okay. And more particularly, because they're in that current bucket, it's usually going to be very highly liquid cash like securities. So things like treasuries, highly liquid debt instruments, commercial paper repurchase agreements, etc. Now, it could also, and again, you'd have to look at the notes, it could also consist of equity securities. Equity or debt publicly traded would also be considered a marketable security. Non-marketable securities would be private securities. Okay. So those would be securities that they own in private entities. So from what I recall with Alphabet, I looked in their 13F filing, which shows investments that they have in other companies, specifically focusing on the publicly traded companies. And they had about $1.6 billion invested in other equities across 40 different companies. So that's going to fall within that marketable securities piece. Okay. So deferred income taxes, we didn't talk about that. PP&E, we talked about that. Operating lease assets, we didn't talk about that. Goodwill, we talked about a little bit. Other non-current assets. Okay, so let's look at each of these individually. Deferred income taxes. So those are income taxes. This is on the asset side. So these are going to be credits that you have. Property and equipment, we talked about that. Beginning PP&E plus CapEx minus depreciation equals ending PP&E. Operating lease assets, this is something I would just keep flat. All right. So basically, now with the new accounting law, came out 5 years ago, basically companies that rent have to factor that in, and they have to book that as an asset, as an operating lease asset. Goodwill, whatever they overpaid relative to the net assets for any M&A transaction, and then other non-current assets. So again, we see a lot more items here than we saw in the file that we were going through earlier. But don't be alarmed. You're basically going to say, okay, I'm going to deal with accounts receivable. I'll deal with PP&E, and then I could just kind of keep the rest of the stuff flat. Literally, like that's what you would do. Then we come over to the current liability side. So you have accounts payable, accrued comp and benefits, accrued expenses, other current liabilities, accrued revenue share, deferred revenue. So there's a lot of stuff going on there. What's absolutely incredibly important, accounts payable. A lot of the other stuff is just kind of accounting related constructs. So something like accrued compensation. Okay. So I actually used this example in the training I was running today. So wages payable. Let's say you work at a company and you get $2,000 every 2 weeks. That effectively means that the company is going to recognize $200 every day for 10 days. Okay. That's going to be captured in that accrued compensation and benefits. So what's going to happen is every day they're going to expense $200 and then they're going to result in an associated accrued compensation. And it's going to continue and continue until you actually get paid. The accrued compensation goes down, cash goes down. Okay. Debt is pretty obvious. I would still always look at the debt breakdown. See how much they have is one thing, but also see what is going to be the pay schedule on that debt, how far out the maturities are. That's important. Income taxes payable, non-current. So these are taxes that they owe over a longer period of time. Operating lease liabilities is literally the corresponding entry to the operating lease assets. So effectively, if you're a business and you operate within a building, okay, and you're leasing the building, you don't own the building, you have an asset. You can run your business there. But if you don't pay, that's a liability, right? So you have both pieces of the puzzle. So effectively, they neutralize one another. Other long-term liabilities, kind of like the junk drawer. And then they don't have any preferred stock. It's authorized, but it's not issued or outstanding. They have each of their share classes broken out right here. Okay, so that would be your paid-in capital. Accumulated other comprehensive income. So that's like FX effects, translation gains and losses. And then our old pal retained earnings. So what do we see here? We see a lot of stuff here not much of which is actually relevant from a valuation perspective or a financial modeling perspective, but there's a heck of a lot of stuff here, okay? But it's important for you to look at it and see how it evolves over time. Is it getting better? Is it getting worse, et cetera? So that's really what we're kind of looking at when we look at the balance sheet. Now, ultimately, what we need to do is we need to take this information, we need to pop it into Excel, look at it on a historical basis, and then make a determination, come up with, for example, growth rates, margins, ratios, et cetera. That's really what we're going to do. So we come over to the income statement. Okay, so we have revenues, and then this is actually a very simple income statement. So they do have research and development here. So we've got revenues, cost of revenues. So again, when you think of a business like Alphabet, you're not thinking about selling physical products. So they don't have it listed as cost of goods sold because they're really selling a service. R&D, all right, so all the research that they're doing to try to create new AI-related search engine optimization, et cetera. Sales and marketing, general administrative, okay? That's their total costs and expenses. Nothing beyond that. Income from operations, other income expense net. So if you actually look at the detail there, that's where they're going to break out interest income, interest expense, and then other income expense items. Then they have pre-tax income. They pay their taxes, net income. So this is a super simple income statement. We saw a lot of noise up top when we looked at the balance sheet, not so much here, okay? The income statement is typically going to be pretty simple, pretty straightforward. Basic versus diluted. We're talking about basic. Those are the shares up top. Diluted would take into account any in-the-money options, so it would increase the share count as a result. That's why the diluted EPS is lower than the basic EPS. That's it for the income statement. Pretty simple and straightforward. We don't care about the comprehensive income, statement of shareholders' equity. Again, this is just looking at the changes in each of the items that make up the equity. So the additional paid in capital, accumulated other comprehensive income or loss, retained earnings, and then you add those across and you get the total stockholders' equity. So again, this doesn't drive anything. All it's going to do is give us the associated details on the equity side. Then we have the cash flow statement. Okay. So the cash flow statement, obviously very important for us to understand because this is what drives value. This is arguably the most important of the three financial statements. So I'll make sure to keep the years up top. So this is pretty unique. They have 22, 23, 24. A lot of companies actually do it the opposite way. So that's a pleasant surprise. So they have net income. Then they have the adjustments to net income. So these are going to be non-cash charges. So depreciation, stock-based comp, deferred income taxes, loss or gain on equity securities. So they have to book that, and then other. Then they have changes in assets and liabilities. This would consist of what we were talking about earlier, the operating working capital. So we have accounts receivable, income taxes, other assets, accounts payable, accrued expenses, blibbity blobbity. Okay. So that takes care of the operating cash flows. The investing cash flows, remember, this is 22, 23, 24. Investing, we have purchases of property and equipment, also purchases of marketable securities. So remember, this is a company that has tens of billions of dollars of cash. They're investing a ton of money into marketable securities. So they're deploying that cash in a positive fashion. They're making a ton of money, okay? Over $100 billion in 2024. And then we have the purchases of non-marketable securities and then the associated maturities. And then acquisitions. All right. A lot of times people confuse this with purchases of PP&E. It's not. Acquisitions are separate. Property, plant, and equipment is assets that are purchased via CapEx and then depreciated over time. Acquisition is you're buying literally an entire company, an entire entity, an entire business. Last but not least are financing cash flows. So they break it down into net payments related to stock-based award activities. So basically any stock options or stock-based compensation, they're accounting for that there, the actual payments, repurchases of stock, dividend payments, proceeds from debt, net of costs, repayments of debt, and then proceeds from sale of interest in consolidated entities. Okay. So they have their FX effect. And then, as I mentioned, net increase, decrease in cash and cash equivalents. All right. So that is basically operating plus investing plus financing. To that, you add the cash at the beginning of the period, and that will give you the cash and cash equivalents at the end of the period. And this 23466 right here, wait for it. That 23466 right here, go up, 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 back, 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 23466, 23466. Ba-bam. Check me out, y'all. 23466. And that's it. And if you ultimately want to go deeper, you just do a control F, look at any of those line items, and then you'll be able to find it later on in the notes to the financial statements. And that's how you get to understand company financial statements. And as a cherry on top, I will show you the back end, the guts of my financial model that I built specifically for Google Alphabet. So I take all those financials and bam, here you go. It's like looking into my laboratory. All right. So I literally lay out all of the financials for all of those historical years. And then also in this particular instance, I was looking at changes year over year, 2Q24 to 2Q25, blibbity blobbity. So I'm going to calculate the returns on invested capital, the return on equity. So in the case of Google Alphabet, massive increases over time, very, very impressive. This is something that's really unprecedented. It's like this is like world class. You're talking about your 4xing your return on invested capital. And, you're almost, let's say, 4.5xing your return on equity. This is just like world class. This is unbelievable. This is like Olympic level stuff here. Then we look at cash conversion cycle. Okay. So we're looking at their receivables, their inventories, of which they have none, and their payables. So in this case, they have a cash conversion cycle of about 30 days. All right. So not really good or bad. We just don't want to see it kind of like getting out of control. Remember, they're doing, making money from ads and searches. So they're not selling any like physical goods. They don't have stale inventory to worry about. So we look right here. We see the margins are just like absolutely redonk. You look 2020 until 2024, you look at all of them are just increasing across the board. Some of them pretty substantially, like operating margin and net margin. But here's the crazy part. This is the crazy part. Okay, 2Q25 relative to 2024, every single number is better, like, and significantly so. So 2Q25 was the highest since 2017 on gross margin, highest in 8 years on EBITDA on operating, highest since 2021 on net margin. I mean, this is just like they're knocking it out of the park. And then we have the cash flow statement. And all of this is going to be utilized to create our lovely financial model. And that's it, y'all. I also did segment and geography breakdown. All right. Hopefully no brains are exploding or anything. So there's a lot of detail that goes into this. When you look at all the depth of understanding and knowledge that's going into, creating the YouTube video, like this is all the stuff that's happening in the back end. I always love, some of the creators that I see and they're like, this is what I think. And it's like, I don't think, I let the numbers tell the story. Okay. Like the numbers say this is pretty darn good. Everything's going well. All right. Trending in the right direction. That's what I do. Okay. And then I also had some other stuff here, looking at the international business, the breakdown, United States, EMEA, APAC, and other Americas. All right, friends. So I'm going to stop sharing my screen, and then any questions that you guys have, pop it into the chat and feel free to fire away. This is going to be something I'm going to do more in the future. So, any ideas that you want to hear more about, happy to opine on that as well. Okay. So niche question on the 3-statement model. How do deferred fees fit into a 3-statement or LBO model? Very good question. So what he's referring to there are deferred financing fees. So deferred financing fees are effectively amortized. So you would kind of treat it very similar to amortization in an LBO model. You're basically just spreading that cost over time. So that's that one. Next one. I made this like little combo of like seltzer and like electrolytes, and it's pretty good. Very happy with it. Other questions? And we could get into an LBO model, not tonight, but later on I could walk you guys through stuff. Other questions? Dun, dun, dun. It's like... But I wanted to try to make this live stream a little bit different, where it's kind of more like a Q&A, like I teach something and then it's more of a Q&A versus like the Friday stock valuation video, which is like obviously a stock valuation. I didn't want to just make this like a repeat of that and just keep talking about the same stock. I want to kind of like break it up a bit. So other questions, feel free to fire it in the chat. More than happy to answer it. I'm here for you. I'm a man of the people. Anything else? Meow, meow. Very quiet. Unless somebody's writing like War and Peace, someone might be writing like a novel in the chat. That could be happening as well. Dun, dun, dun. All right, y'all. I'm going to do what I do when I teach. I'm going to give the countdown. So I'll give, once we hit a 30 seconds, that's when I'll cut it off. All right. Non-financing questions. Go nuts. Yeah, man. I don't care. Ask me anything. Favorite color is blue. I like long walks on the beach. Yeah, any questions? Career, networking, whatever. Fire it away. Fire it away. Yeah, you guys can ask me anything. I don't care. I'm an open book. I actually enjoy the non-financing questions. Would I put deferred financing fees as an asset? Well, think about that. Would you? If it's a financing fee, is that going to be a positive economic benefit, or is that going to be something that would be an outflow? I see what you're saying. Yeah, prepaid expense. Yeah, that's I guess yeah, that's one way that you can think about it. Here, I'm gonna actually pull up on my end. I have an LBO model with deferred financing fees and the sources and uses. I'll do that while I wait for the questions to all fire in. Dun, dun, dun. Ooh, thoughts on Berk? Yeah. So it's kind of crazy. Berkshire is very interesting because if I do a YouTube video on Berkshire Hathaway, like no one will watch it. And you're like, what do you mean no one will watch it? Everybody will watch it. It just has like horrible, like absolutely horrible search juice on it. I know it sounds crazy, but it's true. It has like just absolutely horrible search juice on it. What do I think about it? I mean, it's getting very compelling right now, like hard to deny. So Sam, real quick, I'm going to answer your question. Yes, you're thinking about it properly, looking at it as a prepaid expense. Yes, an asset. That's correct. I was confused with how you were asking it. But yes, that is the proper way to think about it. So back to Cooper. So thoughts on Berkshire. It's kind of funny because people are looking at Berkshire as a barometer for what Warren Buffett thinks about the economy. And this was something that came up, was it last week or the week before? Whenever I was at JP Morgan and someone was asking me, like, what do you think about Berkshire? And the interesting thing was I said the following. I said, I honestly think that Warren Buffett has accumulated so much cash so that his successor, Greg Abel and the boys, are able to actually have cash to deploy, to let their ideas, breathe some air and see some life. If you think about it, if they were taking over a fully invested portfolio, you really don't have much optionality there. You're basically just a portfolio manager, which is fine, but you're not really letting your ideas take shape and take hold. So I think that's why there's so much cash available. But I do think if you looked at it on a sum of parts basis, it has to be at a fairly significant discount. And again, this is like easy math that you can do. You just take all the shares that they currently own from the 13F filing, multiply it by all of the current share prices, and then you're going to get what the actual value is, and then you slap in the cash. Now, if you really wanted to go bananas, what you ultimately would do is you would get the intrinsic value of all of those pieces that they own, and then you'd see what the true intrinsic value is of Berkshire by that way. That would be obviously a much more involved endeavor. Every so often, you'll see somebody do that over time. Like they'll like freshen it up and do it when it gets at a particular discount. But yeah, I'm a fan of Berkshire, dude. I think that it's definitely at a discount now, but that's one that I definitely have to freshen up, frankly. Giovanni, if the company's net income is growing, but operating cash flow is consistently lagging or negative, what might that indicate? So really good question. It's kind of ironic. I was actually talking about this today with the training I was doing. Net, if a company has negative operating cash flow, they're just not long for this world. And the reason being is there's only two ways that you can make it from there. You either have to go raise debt, raise equity. And if you think about it, if you're losing money, who the heck wants to lend you money? Nobody. Who wants to invest equity in a company that's losing money? Nobody. So then at that point, your only other option is you're going to have to sell assets. Now, if you think about that logically, if you're selling assets, those are the same assets that generated the net income that is not like helping you in the first place. So that would kind of be the beginning of a death spiral scenario. Now, if the company's net income is growing, but operating cash flow is consistently lagging or negative, what we would have to do is look at those other components. So you'd have depreciation and amortization. That would be a boost. So that wouldn't make sense. So then you'd have to look at operating working capital. So effectively, what I would say logically is the company has a really poor job in terms of their operating working capital. They might actually be too aggressive on their accounts receivable and how much they're actually going to be able to collect. So they might not be having a large enough allowance for doubtful accounts. And what would happen in that case is you end up having to write off those receivables. So that could be a huge negative. If you have inventory obsolescence and the same thing would happen, you'd have to write that off. That would be a huge negative. And if you're paying your payables faster than you're receiving your receivables, that would also be a negative. But I would say it would be rare. It would be very rare to see a company have like massive and growing net income. And then in turn, they're also generating negative operating cash flow. They would be really horrible though on their working capital. They would be like horrifically bad, frankly. Other questions. Dun, dun, dun. Dun, 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 dun. Wake up, questions. I'm going to do this moving forward. So you can mark the calendar, 7 p.m. Before Monday Night Football. You could go check me out. Gazing, gazing. All right, get the timer started. No other questions. I'm going to hit the road. Got to work on this week's YouTube video, obviously. So that's a big one. Yeah, full sum of parts on Berk, dude. Kudos to you, my friend. Yeah, I would say if you're looking at each of the pieces, some of the stuff in there is kind of interesting, though, like the ownership in the Atlanta Braves. That's always a challenge because it's like you look at the value of sports franchises, and I think that would be probably worth more on a sale basis. But not necessarily on like an enterprise value basis, but there's a lot of other compelling parts in there. What are your views on the markets hitting all-time highs? I still think there's a lot of value and I see a lot of pockets of value. So I'm not like what goes up must come down. I would say the things that are kind of more alarming are when you look at, for example, the unemployment, like when you look at the most recent numbers and you see kind of like the unemployment that's occurring in tech that is related obviously to AI. And you hear people saying like, I don't need 5 programmers underneath me because now I have AI do it. That one is a little like, I don't want to say scary, but we're going to have to obviously change how we look at things. But that being said, I don't see like plumbers and electricians having issues on the unemployment line. So I think that that's another way to think about it as well. But I don't just think overtly because the markets are at all-time highs. I do think like some things, and again, I'm a proud owner of Meta and Microsoft, but sometimes like the reactions to these quarterly earnings numbers are like, okay, I get it. These are good numbers, but it's like, were they that good? That's the kind of stuff that's a little crazy. And then on the flip side, sneak preview this week is going to be Amazon. On the flip side, Amazon, it's like reports great numbers and like they get eviscerated. And like that kind of stuff doesn't make sense. Hard to do right now. They don't give specific. Yeah, dude, it's going to be very difficult to do the sum of parts analysis on Berkshire Hathaway. I would say, honestly, if I did it, like even with my speed proficiency, it would probably take me like legit solid month, month. Pete, hey, what's going on, man? Huge supporter. Nice. No, thank you. I do this for you guys. So Coop said job numbers have been rough for more than a year, but the headline number has kept people from diving into it. Yeah, I think, the real shocker with the market is the time that we're in right now. Like it's August. Like this is very weird for markets to be at all-time highs during the summer. There's an old saying, sell in May and go away. And where that comes from is there was a study that was done years ago, and it's still valid. If you sold your entire portfolio in May and then you bought it back like Labor Day, basically think of like kids, off from school and everything because everybody's on vacation. And, it is true. Like the volume in the market is down over the summertime. Like they've actually shown and proven that you would outperform if you did that strategy. Ironically, though, it's not working this summer. It just keeps powering on. I think that's the part that's a little bit more surprising. My question is on eVTOL sector. Who do you think the winner coming out of this should be? The retail investors were thinking about putting some scared at the game for a 5-year view. Okay. So again, I just want to be very clear. I want to see cash flow. I love things like cash flow and value and intrinsic value. Now, people ask me like, can you look at Archer Aviation? I looked, no revenue. Okay. I can't build a model off of that. Now, ironically, I would say bet on Joby. Okay. And that bet has actually worked out pretty tremendously. So I'm not like going to be one of these people on YouTube that's like, I'm a genius and I knew this and all that stuff. I honestly looked at it. I read a really great book called 100 Baggers by Chris Mayer. Highly recommend it for all investors. And he was talking about the characteristics of companies that have the potential to 100x. So, and again, full disclosure, I put $5,000 into it. Not like any crazy number, like all the money I have. No, that's like stupid. And I basically looked at it. I'm like, hey, I'm just going to let this thing ride. And if it, goes to zero, I'm okay with that. That's basically like my mindset. And then I looked, I thought I had bought it like way long ago. I actually bought it in like early 24, late 23. And that thing, my average cost was like $450. And that thing is just like had face ripping. I mean, geez, like even today, like I got texts from people who are like, dude, Joby. And I'm like, I like forget about it. It's now become it's choking me up here as a result of this like insane market. And then they bought Blade, all this stuff. It's now become the largest holding in my portfolio. So it's the complete opposite of everything that I stand for. It's actually bigger than my Microsoft holding, which is like hard to believe. But I would say as a sector, there have to be like eVTOL, like ETFs, something like that. Again, I think Joby, like it has not just proof of concept, but they actually have something that is flying in the air, and they do generate revenues. But when I did my research on Joby, it was the people that were running the company and that were the investors, like that's what got me really excited. It was like former Amazon executives, Uber, like it was just like really, really smart people that were going to make sure that they had a long enough runway. That's very important for companies like this. But here's the thing you got to be careful of is I would not put a huge amount of your portfolio in something like that. Case in point, I'm going to be full disclosure, open and honest with everybody. When EV was going bonkers in like 2021, I had a lot of exposure to EV. And at the time, it was like, like you just close your eyes, throw a dart, and it was like everything was rocking and rolling. But over time, guess what? Earnings matter, cash flows matter, and a lot of those companies are gone, don't exist any longer. So most of them went bankrupt, and I'm going to say like it's very, very much the case that it's going to happen. The same thing in the eVTOL sector. So yes, Pratyush, I totally agree. Meta and Microsoft have absolutely been killing it. People thought I was like crazy when I said Microsoft is the best buy in the Mag 7. What is that, like 360? And I said it was like 450, then it goes to 400. I'm like, yes, Microsoft. I just kept accumulating and accumulating. And then it has like great earnings, and it's like, 540. And it's like, where'd this come from? But, it was kind of like hidden in plain sight. So Ivan, 100% correct. Startups usually burn cash, have negative income from inception. How do you assess those companies? So you really honestly have to look at it like if you were like looking at a venture capital valuation, it's literally a decision tree. So it's okay, I'm investing here, and if it works out, I'm going to make this much. If it doesn't work out, I'm going to make this much. Like that's literally how it is. I know that sounds insane, because to your point, like you can't build a DCF model off of this stuff. So what would be the value if it works out? That's kind of the way that you would look at it. So that's kind of one of the wonky things with that. But again, startups, I would rather miss out, on the beginning part. I mean, you could take any example, Tesla, Nvidia, any like great performing stock. You could have hopped on that train a lot later. Even another one, fearful of even saying it, Bitcoin. There's so many examples of things where you could have like missed out on the front end and just kind of let other people get like the spoils of the beginning. But you knew at that point it was like had proof of concept and it's going to continue. That's usually what I like. Like I need to at least see revenues. I know Archer Aviation fans are gonna pillory me for that. You need revenues? Like what kind of crazy person are you? It's like, yeah, bro, I need to at least see freaking revenues. And obviously things are headed in the right direction. But honestly, Ivan, what you would look at is the cash burn rate. How long can they make it? When I looked at Rivian a few weeks ago, and I always love this, like, the troll comments, you're dumb, you don't know, like, oh, a Cro-Magnon. It's like, oh, okay. Like, it's math. Like, I looked at it, it's got 6.6 years of runway. I'm pretty okay with that. I think they're going to figure it all out within 6.6 years. In addition to all the money that they're getting from Volkswagen, they have two huge investors. Yeah, I'm not worried about them. So I would also look at the cash backing, because at some point the venture capital investors, they just pull the plug. Adios. It's just so that's what happened with all those EV companies that went up in smoke. Do you have any thoughts on public markets with all the super successful IPOs? Yeah, so great book, highly recommend The Intelligent Investor by Benjamin Graham. Warren Buffett always recommends that book. So I'm trying to remember what edition it was, but Jason Zweig wrote the intro of the edition that I have. And I mean, it's from, probably sometime early 2000s, I would say. And he did a study of IPOs in that book. And I think it was some ridiculous statistic, but it was like 80% of IPOs 5 years later are lower than their initial IPO price. It's like, what? I am not a huge fan of IPOs. Like Rivian, right? Okay. I'm a fan of Rivian now. But 2021, when like I can't tell you how many people are like, oh, Rivian, oh, and I'm like, bro, this company is very, very far away, like very far away from even seeing like positive gross profit, EBITDA, etc. Like, stay away. Oh, you don't know what you're talking about. You dumb. Like, oh, okay, got it. And then what happened? Freaking 120, like 10. That's the thing that you have to be careful with the IPOs. Not a fan of IPOs. Yes, successful IPOs, that is indicative of a robust financial market, positive investing environment. That's what that's indicative of, 100%. But I would not say that means that you should invest in IPOs. I think it's really more of a testament to the strength of the market and the pool of investors than anything, honestly. Would it be wise for a young investor to use leverage ETFs? Oh boy, to try to get higher returns. Logic being that we can recover in case of a 99% drawdown. So I'd be very, very careful with that logic, and I'll tell you why. The math that you're probably doing with the levered ETF, like a 2x or a 3x ETF, is not correct. And it's not because you don't know how to do math. It's because those levered ETFs are rebalanced very frequently. But also, you will see, I had an individual who did a short triple levered oil ETF. Short. Okay. Now this was, I'm trying to remember, was it COVID? No, it was pre-COVID. And what ended up happening was oil was going down and they were convinced it was going to go up. And what happened was it just freaking tanked. But for those of you who are not aware, once it goes below $5, it runs the risk of being delisted. So effectively what happens is it does a reverse split. So it goes back above 5 and then it goes below 5, reverse split, reverse split, reverse split. So those levered ETFs, not a smart idea. I mean, this is like, Wall Street bets land, stuff like that. I mean, look, you honestly have to invest for the long term. Don't trade. I know some people are like, what? Don't trade. But I would say, like, I'm very, very careful. Here's what I would say. COVID happens. Liberation Day happens. Yes. When you see something like stupid happening, then by all means, feel free to get a triple levered ETF. And then when everything comes back to normalcy, you'll be like, yay. But unless there's something like that, I would not advise. Okay. The market can remain irrational for longer than you can remain solvent. So, like, Liberation Day happened. I backed up the truck. I was buying Amazon like in the high 160s. I bought Meta at 480. Like, yes, that's when you're like, okay, this is crazy. I've got to hop into this. That's when you do that. But you don't just do it for the sake of it. I would not advise levered ETFs. Oh, nice. 100 Baggers. Yeah, just got my book for the fall. Yeah, 100 Baggers by Chris Mayer. I'll do a freaking YouTube video on that. Like, that book is just like mind-blowing. So what ended up happening was there was a gentleman, I'm going to have to remember, it was Tom something, I believe, in the 70s. And he was curious. He was like, I wonder how many companies have 100x'd and looking back historically. So he did this whole study and he published it, and it didn't receive any like particular fanfare, but I heard about this and I was like, holy bleep. And this other guy, Chris Mayer, was like, I wonder if anybody's updated that study for like modern times. Nobody had. So he was like, oh, let me update it. So some examples, like Southwest Airlines. Southwest Airlines, when it came out, I think it was in the early 70s, it was 100 bagger in like 3 years. I mean, but you think about like the model that they had, like flights in like the Southwest, mainly Texas when they started out. I mean, it was just like totally disruptive and revolutionary. Amazon has been 100 bagger twice. Because after the tech bubble burst, it then ended up coming back. So before the tech bubble, it was 100 bagger. And then after the tech bubble, it was 100 bagger again. Monster, or Hanson Natural, which then became Monster, that was 100 bagger. So there's a lot of well-known companies that have been, but spoiler alert, one of the biggest things for a company to become a 100 bagger is time. You have to give it enough time. So I gave the example earlier of Joby. Like, I'm not selling it. I've 4.5x my investment. Not in a rush. So just let it ride. So I don't want to be that guy. Like, it's like, yeah, I owned it. It's like, oh, you own it? It's like, no, I did. It's like, when'd you sell it? It's like before it kind of went up like a gazillion percent, you know. But the idea with a 100-bagger is if you invest $10,000 in it, you're going to end up with $1 million. That's the logic of a 100-bagger. 100-baggers by Chris Mayer. Highly recommend the book. Check it out. Yeah, not interested in buying the IPOs, thank God. But just what it would mean for markets and possibly a move back towards public versus private. I mean, look, me personally, I'm a huge fan of private. Like, don't go public. And, you know, there's many companies out there that are private that are worth multi-billions of dollars, like Coke Industries, you know, Wrigley. There's a ton of companies out there that are private that are super successful. Once you become public, you know, the restrictions, the need for constant oversight, reporting, all that stuff. It's just like a very big headache. So Giovanni said it'd be dope if you covered Reddit. Now, here's the interesting thing, and I'm going to actually check it real time. So bear with me, friends. Last I looked, the EBITDA was like super duper negative. So it was kind of like there's really no point. But I'm just going to check real time and see if anything has changed on that front. Okay, it looks like it is turning the corner. So that one could be one that we'll check out. I'll put it on the to-do list. I think that one would be interesting as well. But when I looked at it like shortly after the IPO, it had pretty negative EBITDA, but I'd like to hop into that. Deepak, what's up, man? Yeah, the IPOs. Yeah. I mean, look, if you're able to get in early enough and just like get like a 50% return in a day, like, hey man, God bless you. But just understand it's a trade. Sometimes it'll work out, sometimes it won't work out. Pratush, I was listening to Buffett on return on incremental invested capital. Very good one. And its benefit. How do you calculate incremental invested capital and views on the metric? Big fan on the metric. I guess really the point when you think about return on invested capital, you have EBIT, operating income, minus taxes, and then you're looking at it relative to debt and equity. Okay. Now, what that's not factoring in is the new capital that you're raising. So interestingly enough, when I covered Google Alphabet last week, they actually like jacked up their debt. And I was like, huh? It was like kind of weird. I looked, I was like, wait a second, their debt like doubled. So I'm like, what happened here? You know, is this for AI? Like, what's going on here? And they gave the reason as general corporate purposes. So I was like, huh, that's interesting. I mean, I guess technically, you know, the increase in CapEx going from 75 to 85 billion, that is a general corporate purpose. But I was kind of like, wow, where'd that come from? So what you would look at in that instance is any new equity, any new debt, and then you would look at the EBIT minus taxes on that new capital. So that's really what it's looking at. So effectively what you're doing is you're looking at the difference between one time period and another, that increase, and then the associated increase on the numerator side. But yeah, I think what he's really referring to, return on incremental capital, is are they efficient at the new capital that they're utilizing? You know, I've mentioned previously with like SoFi, they're diluting their investors. If they kept the same number of shares from the IPO to today, I calculated the stock would be worth like $240 a share. Now, and people are like, oh, but it's $22 a share. It's like, I know. So that's something that's kind of like insidious that people don't notice. But if you actually do the math, it's like, oh my gosh, that's pretty scary. It's like, yeah, it is. But yeah, I'm a fan of that metric. I've used another metric he likes is return on retained earnings, because you have companies that have negative equity because they've done so many share buybacks. So I like return on retained earnings too. Oh, and so then Deeped said, reinvest in companies when the valuation reaches the fundamental analysis says based on the DCF. Yeah, so if you wanted to like get in for like a pop on an IPO and then get back in later on, when it kind of, you know, is at a discount. That actually happened, ironically, with Meta. I remember way long ago, it's going to be like laughable. It was trading at like 20, 25 bucks. You're like, 20, 25 bucks. When the heck was that? It was below its IPO price. And it was just like a total no-brainer to buy it. So yeah, it's kind of inevitable. Most companies will go at some point within like the first 5 years, they'll go below the IPO price. Another one that comes to mind, real time, Snowflake. Okay. Remember when Snowflake was like the darling of Wall Street? And then it's like, so, what are you going to do? Are you going to hold on to it as it like, goes down into a death spiral? And it still hasn't recovered. I'm actually curious because that one, like everybody and their mother, oh, Snowflake, Snowflake, Snowflake. It's like, okay, yep, got it. And they weren't talking about the weather. Snow. I want to see like all time. Yeah, it's below its IPO. Yeah. So all time high was like 390. Yeah. Yeah. Not even close. Not even close. Crazy stuff. So Coop said so many benefits to being private. However, in the case of Figma, who had a 20 billion private deal fall through and then IPO now sits at like 45 billion, had to turn down over 100% increase versus avoiding the regulations. Yeah, I would say honestly, dude, like tech is one of those areas where you would be able to unlock way more value being public versus being private. I would say that one is pretty accurate. I just feel like the growth potential and public markets valuation and incorporation of that growth potential ends up causing those public companies that are tech companies to get a bonus or premium valuation being public versus private. Totally agree with that. But unless it's something, I would say like AI, quantum computing, like definitely like a tech focus, I wouldn't really be in a rush to go public if I were a private company. What are your thoughts on Tom Lee as an investor? He's the CEO of Fundstrat, Granny Shots ETF. He's now being added as a board member for BMNR, which is expected to be the MicroStrategy of Ethereum. So, look, I'm a huge fan of visionaries. I love Leonardo da Vinci, for example, or Benjamin Franklin. Now, obviously, people have thrown a lot of shade towards Elon Musk. I would say right now, Tesla's in that weird phase where they're kind of like in the process of transitioning from an EV company to a robot, self-driving car, AI company. And it's very difficult to kind of see what that's going to look like. I think Tom Lee, I don't know enough about him, honestly, to give like an objective opinion. But I would say like someone like Kathy Wood, she's also like a visionary. But the whole thing is this. I think there's something to be said for like a concentration of effort. So, love him or hate him, Elon Musk is focused on, Tesla, SpaceX. Okay. Like those are like the two things. He's not doing like 50 million things. I always get a little concerned when someone is like a Kathy Wood, they're like trying to be like the Warren Buffett of tech. Like you're never going to hit everyone out of the park. And when you're adjusting your portfolio so frequently, that you have to be careful with. But if he's trying to be the MicroStrategy of Ethereum, look, when Bitcoin, Ethereum, whatever that associated crypto is that they're going to accumulate goes up, they're a genius. Oh my gosh, unbelievable. But then when it goes down, it's like, what were they thinking? Why'd they do that? So you just have to be ready for that. One thing I do have to say, which was very interesting, and feel free to look in this on your own. I was looking at the preferred stock that MicroStrategy has issued. That's pretty interesting. If you have a chance, go take a look at that. I was a little late to the party there, but when it not like when it was like right first issued, but not that long ago, it was at like a 10% yield. It's still at like between 7 and 8%. So they're trying to finance their purchases of Bitcoin in the case of MicroStrategy. There's like STRK and I think STRF are the preferreds. So let's see, STRK. Yep. And then STRF. Yep. So STRK, STRF. So now they're using preferred stock rather than debt or equity to end up buying Bitcoin. I think that's a genius move because you have a hybrid security. okay, you have to pay the dividend, but it's cumulative. So if you can't make the dividend payment, you just push it out. Um, that's a way that I think is very unique and like a cool way to do it. Just have preferred stock to end up going and buying the Bitcoin, Ethereum, whatever it is. But honestly, I don't know enough about Tom Lee to really give an opinion one way or another. But I would say that the real key is making sure that the person is like laser focused. Like Jensen Huang is very focused at NVIDIA. I'm very confident of his ability to focus. Elon Musk, very confident on his ability to focus. When people are doing like 20 different things, it's very difficult to do a very good job at 20 different things. So that would be kind of my take before doing like deeper dive. What's your take on the AI tech bubble forming? The valuations seem crazy and are totally built on future scope. Is there a possibility of the tech bubble blast happening again in AI? So here's the thing. I was pleasantly surprised that Alphabet / Google was at a significant discount. Most of the metrics, like the top line metrics, were actually like lower in the more recent model, which is kind of interesting. And then obviously the CapEx was higher. So I was like, that was an interesting result. I venture to say I'm probably going to get a very similar result with Amazon as well. The ones that are like concerning, definitely Tesla. Like it's very hard to get like visibility on what all this is going to look like. So that's trading at like a pretty frothy multiple right now. It's probably due for a pullback. But look, Microsoft, Meta, did they rip after they reported? Yes, they did. Yes, they did. But I don't think they're like out of the stratosphere. Apple's the one that's a little bit more concerning because it's still trading at a premium multiple, but it doesn't really have the plan for AI. That one's the one that is like kind of a bit of a head scratcher there. So I'd say like Apple and Tesla are a little odd. I would definitely say Nvidia is getting to the point where it's like, okay, guys, like we're taking way too much in the future and bringing it to today. So I would say I don't think you're going to see a crash per se. I'd say you're probably going to see more so like things going sideways or kind of like floating downward a little bit. But I would say be very careful with any of like the tangential securities outside of like the core Mag 7. Like none of the Mag 7's going away. I could say that with 100% certainty, but that doesn't mean you want to overpay for it. Like when I did the most recent Nvidia video, the stock was at $97 and I was like, buy with two hands, and it ripped. So it's like, okay, it ripped. Is it worth like 170 something? It's like, it's kind of getting like a little like beyond the beyond. But again, growth has to catch up. The results have to catch up. So it's like years ago when people are like, the PE ratio of the market is so high. It's like, okay, well, one of two things has to happen. The P has to go down or the E has to come up or some combination thereof. Now, it could be that the E comes up. Yes, that's entirely possible. But it's not just going to be the P. It's probably going to be a combo. Palantir. So Palantir is a very interesting case because I'm a fan of the company, the management, the business model, the whole nine yards, but it's like on every metric like imaginable, it's overvalued. Like that's the part where it's just like you can't wrap your head around like this being a correct valuation. There's obviously a very, very strong retail element there that is like pushing the stock. Like you've seen that with Hims as well. That one I freaking don't understand for the life of me. It's like there's other companies that do the exact same thing. It's like you have the issue, you resolve it, you move on with life. Like I don't get it. But some people just go bananas on it. Palantir, very different though. The issue with Palantir is actually being able to articulate value because they don't know what they're going to be able to do until they actually go into your data. It's a difficult company to understand, but effectively, they're going to find efficiencies with your company by analyzing big data. that's effectively what they do in a very simplistic fashion. There's still a lot of companies that don't use them that, could/should use them. Again, it's just the total addressable market and like what the current penetration is relative to what the future penetration is. And like you're being valued as though you have 50% market penetration, but you have a 5% market penetration. So you're very early on in the game, but it doesn't mean you're undervalued. Like if someone said to me right now, should I buy NVIDIA? I would say no. It's like, why? It's like, well, it's not going to grow at the same rate in the future as it did in the past. So like I would wait for a pullback and then get into it, but don't like chase like AMD. Like, should I buy AMD right now? No. Doesn't mean it's a bad company. It's just like it's overextended. Like, don't do it. Not smart. Let's see. I'm suspicious of MicroStrategy. Yeah, I think you're not the only one, my man. Let's see. I think they are running a convertible arbitrage play, making money from their convertible bondholders, not necessarily common stockholders. Okay, that's a valid point. Again, it's just like hoarding, Bitcoin, and like Bitcoin does well. I mean, it rips, it crushes. I would say if you were going to play it, I do like the preferred stock route. But again, it's a very, very difficult. I know he's like pro Bitcoin, the whole 9 yards. Like I'm pro Bitcoin as well, but I'm also not like as insane as people are like, it's going to replace all currency. It's going to be worth $1 trillion, one coin. It's like, like that type of stuff is just like, what are you talking about? I just can't wrap my brain around it. Like I need to understand the math. So I totally respect your suspicion. Yeah, hard to argue with NVIDIA when their revenue's up 70% for a $4 trillion company, but are they going to be able to continue that trajectory? Mathematically, it's impossible. There's no way. Like it's not possible. So that's the problem. Is it's overextended. Will it be worth like and be undervalued at its current value? Eventually, yes, 100%. Does that mean it's a buy today? No, not necessarily. But again, there's some people that are like, yeah, dude, back up the truck. I would rather, get in at a lower rate. Did you have a look at PayPal earnings? Interesting company. Yes. I would say that is one that I'm going to cover within the next couple of weeks. I'm really just trying to get through the Mag 7. So I did Apple, Alphabet. I'm going to do Amazon this week. But PayPal is definitely one that's on the radar for sure. Intel. So very simply, Intel's Foundry business is like a cancer. It's the only way I could describe it. I know it's like a very like jarring thing to hear. It's like, oh, cancer. It's like, yes, cancer. Imagine cancer. So all the rest of the business, phenomenal, doing very well. But like, imagine if like you got a nice haircut, or you're wearing like a cool hat, or like your face looks like very cheery, but like your whole body's riddled with cancer. It's like, who freaking cares about the beautiful face and the haircut? That is Intel right now. Intel has to dump the Foundry business. Unless and until they do that, I would not go near it with a 100-foot pole, not a 10-foot pole, a 100-foot pole. And the issue is, all the money that they're making in the other sides of the business is literally being eviscerated by the cancer that is the Foundry business. It is just a horrible business. It's a low margin, capital intensive dumpster fire. Okay. So the bottom is going to occur when they say, look, we've had it with the Foundry business. We're dumping this. Here's the problem. They took $8.5 billion with a B from the CHIPS Act. The CHIPS Act was predicated on, wait for it, the Foundry. So now they've tied themselves to this stupid Foundry business, which is, again, like cancer, dumpster fire, whatever, like, horrible thing you want to add to it, a dumpster fire while you have cancer. Yes. Okay. That's a good one. So when you think about it, it's like, if they can resolve that, I would say it'll go from like 20 to 30, like that. Okay. If they could just say like, hey, we're dumping the Foundry business, the government's let us off the hook, there's going to be somebody else that'll take it over, but who the hell is taking it over? Like, what private equity firm's like, hey, Anybody know of an asset out there that's losing like billions of dollars like crazy? Like, is there anything that's like just absolutely horrible? We're looking to buy it. No. They actually want stuff that produces positive cash flow. And it's crazy. Like the comments that I got on the Intel video, I was just like, my God, people are like, you don't understand the business. It's like, bro, the revenues are the same that they were 10 years ago. What am I missing here? It's like, oh, well, you don't understand, like the 18A, the nano, the this. It's like, stop with the freaking tech speak. Where are the numbers? I don't see them. Until that happens, until you actually see demonstrable, like, facts, like I need to see fruit from the numbers. Like, you're just basically lighting your money on fire. Now, I know people are like, because the problem is people think of Intel like, oh, Intel Inside, or like, you know, oh, I remember years ago, Intel. It's like, yeah, I remember Eastman Kodak. Where are they? Gone. So don't just say like, oh my gosh, it's the name. Like, dude, I don't want any of you to lose money. Okay. First and foremost, yes, I want you to make money, but I would rather have you not lose money than make money. And I know that sounds odd. It's like, wait, what? You don't want me to make money? No. Let's rephrase that. I don't want you to lose money. Okay. If you went sideways, that's better than going down. Okay. Intel is going down. Down. All right. Until the Foundry gets resolved, I can't do anything with it. That's the key. It's just, and they can't get rid of it because of the CHIPS Act, $8.5 billion. I mean, it's just a disaster. Okay, so Pete, this has come up a bunch of times. So United Healthcare, Novo Nordisk, Oscar Health. So healthcare, okay? Health insurance. Whew. That is a garbage business. Not like literally the garbage business. Garbage is actually a good business, waste management. But look, you are a price taker rather than a price maker. It's a heavily regulated industry. The rules are constantly changing. I would say I would stay away from all healthcare related insurance stocks. Okay. Here's the other thing too. Warren Buffett, really smart guy, insurance guy, right? Yeah. Does he invest in any health insurance companies ever? No, not once, ever, never. So again, it's like, the economics are just not there. If I said to you, hey, bro, I'm going to sell you a beeper. And you're like, beeper? Why the frick would I buy a beeper? It's like, because I'm selling it for 50 cents. It's like, it's still not worth it. It's a beeper. Okay. Same logic. All right. Wes, dude. So you got like ESP. So CMG Chipotle, that one popped onto my radar. That one might supplant a potential video. And I'm not being rude, guys. I'm actually checking the ticker. It went up a little bit, but yeah, that one's still on very much a downward trend. And I'm a huge fan of Chipotle. I'm a proud consumer of Chipotle. But that one has been on an absolute tear, and then just like, unlike Starbucks, which I think is like not a good one to get into, Chipotle, that's a very interesting pullback that's going on there. That one I think could have tremendous value. I mean, geez, it's almost at a 2-year low. I think that going below 40 gets really, really interesting. But again, that's one I'd have to dig a little bit deeper into. But that one is one that got onto my radar. Kind of like Nike, but Nike's already on the trend back. I don't know if Chipotle has bottomed out yet. So that's the one thing I would say about that. Yeah. All right. After hearing the 100-bagger and cancer argument, let me ask, what are your top 3 picks right now? Long-term wealth. What can I load and forget the next 10 years? Good question. Right now. So I can't do a YouTube video on it because the search stats are absolutely like disastrous. But I'm pretty confident on HHH, which is Howard Hughes Holdings. Yeah, there's Coop. So yeah, wild. So look, here's the deal. Simple research, friends. If you look at Bill Ackman investing in HHH, okay, he did it, and again, the specifics, he did it at like $100 a share when the stock is at $70 a share. So you're like, huh? Now, again, he's a disciple of Warren Buffett, which means he's buying dollars for 50 cents. So if he's buying it for 100, he thinks that it's probably worth 150. Okay. He's trying to turn this entity into the next Berkshire Hathaway. Okay. By the time that it's already happening, it's going to be too late. Now, again, you're like, oh, could I do DCF? Da, da, da. No, because he's creating a holding company akin to Berkshire Hathaway. So it's like the assets that are in there that are going to make it Berkshire Hathaway are not there. Okay. It's currently more so like a real estate development company, but that is one I would say buy, close your eyes, and just let it go. Triple H. That it's just kind of been like hovering like between 65 and 70 for a while. I think there's 3 analysts that cover it. That's one I would say check the box on that. Buy, hold, long term. I know this one's going to be controversial, but really hard for me to bet against Elon Musk. I still think there's room for Tesla to go down from here, but who's going to be the winner in that whole race humanoid robots? Like, here's my prediction: 10 years from now, when these 3 things rip, there's going to be a humanoid robot in your house, washing your dishes, vacuuming your carpet. Like, I'm like very much certain of it. You could buy it at Walmart. I know it sounds crazy, but it's coming. So I think, like, we talk about total addressable market. You look at NVIDIA and like chips. It's like, okay, once the data centers are built, like, what are they going to need? Infinite number of chips? No. But when you look right now, there's 8.142 billion people on planet Earth. Let's say half of those people get a humanoid robot. You know what? Let's say 1/8 of those people get a humanoid robot. That's 1 billion people buying this thing at whatever freaking price it's going to be. Like, I don't know. I think, like, find me the product that 1 billion people are buying. Like, I don't know what that is. And that's pretty wild to me. So that one, again, you're going to have to like hold your nose and just wait for it to work out. Alphabet's an interesting one. Like, if I only have 3, again, you want a company that's not too big. So the one thing that's good about Tesla is, I believe it's still below $1 trillion. So, it's going to be able to have some room to run. 997.58 billion. So, definitely. So I would say those 2, you kind of get the option value thing with a company like Tesla. What would I say would be the third one? All right. And again, you just close your eyes, put it away, and see where it's at 10 years from now. I'd want to say something else on like the tech side. I wouldn't go like anything like consumer discretionary or anything like that. You know what? I mean, it's already done well. Maybe 2 out of 3 will work. Joby has like absolutely shocked me. And it's actually like you were asking about the eVTOL. Like, that's one that's going to make it in the eVTOL for sure. There's no doubt in my mind. But I think honestly, they're going to get bought out, so it's not going to make it 10 years. I think somebody's going to buy them out at some point. If you can't beat them, join them. I don't know what the third one would be, honestly. Yeah, maybe if you want a flyer, go for Joby. Because you want something that could be 100-bagger. I'm pretty convinced. I know Pete would be a fan of it, but I think it's definitely an interesting topic. Do a video on the 100-baggers book, the Chris Mayer book, because it's just a totally different way. Like, you look through a very different lens, because it has to have the time and the sustainability to be able to get to 100x. Joseph R., any thoughts on APLD long-term time frame? Let's see. I honestly am not super familiar with the company. I'm just looking here the last couple of years. It looks like it's absolutely ripped recently. I would have to dig into that, but that's a company that could be 100 bagger just from like a market cap perspective. But one of the things that you really want to have to like think about when you think about like the future potential of a company is, do they have a competitive moat? Like, what is their competition? Like, who could potentially like crush them? So even if you think about like very like Warren Buffett thought process, he bought Forest River. Okay, so this is not tech or anything like that. He bought Forest River, was the number 2 maker of RVs. Okay, so I looked at that and I was like, that's interesting. So I'm like, who else is in the RV space? And again, you're talking about like not many RV companies because it's a very difficult business. Number 1 maker of RVs on planet Earth, wait for it, Thor Industries, THO. So I ended up buying Thor, and I think 8x'd on that investment. Why is that? It's a small number of companies in a business that's not going to go away. AI is not going to get rid of recreational vehicles, but that's also not something that's going to, be worth $1 trillion. So you have to kind of like say like cost benefit. But there's companies that don't even exist right now that I think are going to be the next NVIDIA, things like that. Like, it's very hard, to really articulate the potential for companies that are harnessing, quantum computing as well as AI. A lot of the podcasts I listen to, research, etc., has talked about quantum computing is going to make AI look like child's play. And the reason being is it can compute so fast. And the fear is when you talk about, like, for example, a security code, like quantum computing, they're saying like when it hits escape velocity, like there's literally no security code that it couldn't uncrack. So if in the wrong hands, like bank accounts, everything will be like open and fair game. So somebody actually said that the US needs to focus more on quantum computing for that specific reason. So that's pretty scary. I mean, imagine if like a hacker had that ability where they just sat there and like quantum computing could just like rip through, guess all the things, boom, and just start cracking open stuff. Like that's wild. So there's companies that don't exist right now that will come about in the future. You think about humanoid robots. I think Tesla is going to probably dominate that space. But when you think about it, like you have to think of kind of like the second and third order things. So that's why, like, electric vehicles, it's like, it's going to take some time. But like the eVTOL, like the stuff that Pete was talking about, it's like, yeah. Why would you take an Uber and be stuck in traffic when you can literally go in the equivalent of a drone? Yeah. Like when I first heard that, I was like, yeah, that makes sense. But then remember, there's companies that just go away. Someone was talking to me the other day. It was like, hey, remember we were talking about eVTOL? I was like, yeah. They're like, remember the company I told you about? I was like, no. They're like, well, you don't have to because it's bankrupt. Lilium. So you have to kind of look at it in a very different fashion and lens. So I would say, like, if you have a 10-year time frame, you want something that like is definitely going to be there, but then take a few flyers. But I would say like do that with a very small portion of your portfolio. Was doing some research into HHH and wanted to know if you have any worries about the fee structure. I believe 1.5% on returns above inflation. No, not worried about it. I mean, you're looking at Bill Ackman, I think, has done like 40% returns over the last 20 years. I'm okay with it. Like honestly, like look at James Simons, Rentec and his quantum fund, like makes Warren Buffett look like, treasuries. It's like remarkable, like 40% returns for 40 years. It's like, what? Yes. Like that's insane. They literally had to give money back to investors because they made so much money that they couldn't deploy the capital any longer. I mean, that's just like bonkers. Now, do I think HHH is going to do that? Not necessarily, but look, investing, a real solid investor, if you could get exposure to that without having to be, high net worth, have $20 million and a 2-year lockup, that's interesting. That's interesting. All right, folks, we really picked up the pace with this. So I'm going to do this moving forward. You have any suggestions, pop them in the chats and stuff like that. But this will be a weekly occurrence, 7 o'clock. I kind of did like a lesson and then Q&A. We get enough people, we could just do like more Q&A, less lesson. But if there's any particular things you want to learn about, like I can more than happily produce it in this time frame. Dive into stuff, go into current events, what have you. Just happy to help out and help you guys learn in any way that I can. But I'm going to bid you adieu, get some beauty sleep, but plan on same time next week, 7 o'clock Eastern time, and hop in, any questions, but also pop, comment into, next YouTube video, like, hey, I'd love to hear about this, love to hear about that. And I'll cover it. I'll freestyle on whatever. We obviously covered so many different things here. So absolutely, feel free to ask any questions in the chat. And, if it's something that I'd want to prepare for, give me a heads up in the comments in the next YouTube video. Happy to dive deep. I'm here for you. I'm a man of the people, folks. All right, guys, have an awesome night. It was really fun talking to all of you, and I will see you next week. Take care, everybody.